Well, such a fabulous day for the market. Best day since 2008, by the way. You'd expect when a company reports a better than expected quarter, its stock should go higher, right? I mean, that's what happened with Red Hat after the close. But look at Paychex, the nation's second largest payroll processor with a sideline in human capital management services. This morning, Paychex delivered some robust numbers. Inline earnings with higher than expected revenue up 9% year over year. Even better, the company raised its full year guidance pretty dramatically. Initially, the stock popped about 4% on the headline news, trading up to $63.50 right before the opening. But then management started taking analyst questions on the conference call, and the stock got slammed, giving up all the gains, ultimately closing down 51 cents on the biggest day of the year, a biggest day of 10 years. What the heck happened here? In all honesty, I didn't see anything alarming on that call. This was a consistent quarter from a company that thrives in exactly this kind of environment where we have strong job growth and rising interest rates. So did the market make a mistake, or is there something I'm missing? Let's check in with Marty Mucci. He's the CEO of Paychex. Learn more about the quarter and get some insight into the state of the economy. Marty, welcome back to the show.
Thanks, Jim. Good to be here.
Marty, is it just not enough to be able to do 9% and have the usual 1% to 2% growth? Are these analysts looking for a breakout in growth because there's a huge number of new small, medium-sized businesses that are supposed to be starting?
Well, Jim, I think what happened, this third quarter, because of tax reform, we had some one-time items on the expense side. We had some one-time items on positive from the tax perspective. And I think there was probably some confusion in the quarter. We also said that we were going to invest less than half of the tax reform benefit to us over the next year or so to generate more revenue. And I think maybe the models are being adjusted or something. I'm not sure what happened. It was a solid quarter for us.
Well, do you think it's maybe you gave that one example of how much funds you had for available for Fed's funds rate, and you did $3.9 billion in the May quarter and did $4.3 billion this one. Maybe people expected, I'm sorry, it was down a little bit from last year. I mean, do you think that people were bothered by that?
Well, I don't think so. I mean, interest rates are rising. We're up 37% on interest on our client funds this quarter. We're heading, toward, probably $60-some million worth of interest, up from the 45 range just 2 years ago. I think that's all positive. Our revenue growth top line helped by an acquisition we did in the first quarter. At the end of the first quarter, we're still up at the highest we've been in probably 6 quarters from a top line growth perspective. So, and a great dividend yield. So we're feeling really strong about the results. We'll just have to see what happens in the market.
Marty, what is the growth in this country of small to medium-sized businesses right now? Are they opening more than ever, or are you surprised that they're not?
Well, no, I think we're back to a kind of a steady state of new business formation. I think that's a very good thing. I think job growth in small businesses is right there kind of where it was back in our base year of 2004 for our index. We're seeing job growth not increasing as much, but it's steady and it's very sustainable. And we're seeing wage growth, as you know, around 2.7%. It's come down a little from the almost 3 we saw, but it's still a 2.7% wage increase. Those two things are very positive for us, that's for sure.
How about wage inflation? You concerned? I mean, should we be concerned as a country?
I don't think so. I think, you're seeing minimum wage increases and you're seeing some of a scarcity of resource. And I think that's pushing the wages up close to 3%. I think if we can stay in that 3% range, I think that's a good thing. I mean, that's going to get consumers to feel better about saving and buying more. And that's just going to spur more small business growth and growth because of the growth in demand for services. I think that's a very positive thing.
Can you put in perspective, Marty, the difference between a Paychex and, say, a Workday? I mean, Workday's growing at 30%. They're a cloud-based human capital management company. Are these just apples to oranges?
Well, I think so. Workday has really got a much larger client base, much larger clients in their base. They're really in that 5,000, 10,000 and more employees per business. And I think we're seeing the job growth is a little stronger in those businesses. And they're also outsourcing a little bit faster probably right now. And so they're very, very different businesses. I do think what you're seeing for us is that small business growth is continuing. And with the level of regulations and compliance requirements, you're going to see continued growth for us. Minimum wage increases, Family Leave Act, health care changes. That's driving small businesses to outsource.
Now, I think that the investment, I think, is great because you want to grow, but you've been a tremendous returner of capital. Will that continue?
Yeah, it will. We've got a great dividend yield, the highest in the industry by far. And even though we said our margins, our operating margins were going to decrease a little bit as we did these investments, when you look at the bottom line, we're still growing, expecting next year to grow high single digits, if not double digit earnings growth. And we're giving a great dividend yield, the best in the industry. So, I think it's going to continue. And we're excited about taking some of these dollars opportunistically, investing them in additional product enhancements, accelerating those, driving more market demand in a digital environment. And I think this is going to be very good for our top line revenue growth in a few years to come.
I couldn't agree with you more. I think that the analysts were way too downbeat. To me, the pre-market story was the right one. The questions didn't illuminate anything. I want to thank Marty Mucci's president, CEO of Paychex, Paychex. Look, I'm sticking by my recommendation. It's just too good a story to leave. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.